Hi, everyone. It's great to be with you today. My name is Shannon Smith, and I lead the international tax practice for Eide Bailey. And Eide Bailey is a member of a network of firms that helps us serve our clients internationally. The network is HLB. And I have the privilege of being in Manchester, UK today and visiting with our UK firm, HLB firm, Beaver and Struthers. And so with that, I will introduce you to Caroline Monk, who is an executive partner with the firm.
Thank you, Shannon. And I have to say, it's an absolute pleasure having you here. And as a result of Shannon being here, I think we've got the fullest office we've ever had since we've moved to our new offices, because everyone was so thrilled and excited to come and see Shannon. So we're all begging and borrowing seats around the place. But as Shannon mentioned, I'm an executive partner at Beaver and Struthers, the HLB member firm in Manchester in the UK. And we've really enjoyed working with Eide Bailey over the last few months on this series of webinars talking about the implications of moving to and from the US. This is the fourth of these sessions where we're looking at the implications, the US people coming over to the UK and what that means for them in a tax perspective. So we are going to hand over, we've got three people from our team presenting. Julie Hernan, one of our tax directors, who some of you may remember presented on the corporate side earlier on in this series, but she is joined today by Charlotte Kay and Daniel Pope, members of our tax team, who have the great advantage compared to previous presenters because they actually do the work. So they're really knowledgeable, they really know what they're talking about, and we're going to have a great session. So with no further ado, I will just pass over to Julie. Thank you very much.
There you go, and welcome to Manchester. Right, my first slide is a sort of summary of what the UK taxes are, and what I thought I'd do is a sort of potted history of UK tax. And the tax system in the UK has evolved over many years. We currently have national taxes and local taxes, and it is very different to the American system. We're much smaller and much more compact. So historically, UK taxes were collected to fund wars, and it's not only relatively recent that taxes have been in the current format and fund far-reaching projects of our infrastructure, health, welfare, and other basically economic interests in the country. So if we go to individual taxes, we're looking at personal income taxes, and these were first introduced in 1799, and then they were withdrawn, but take the current form from around 1914. They are charged on earnings and investment income that you were beneficially entitled to. If we move on to capital gains tax, now this was introduced in the UK in around 1965, and then reformed in the 1980s. And it's a tax on the increment in value of your investment assets. So if you buy an asset and you sell it, then you'll pay capital gains tax on the increase in value. And it was reformed in 1982, so it's only gains from 1982 that will be charged. And if you're buying an asset now, it's history, so it won't impact on you. Inheritance tax, another individual tax that has a longer history. So the history of inheritance tax, it's a death tax, and that was brought in around 1694 with stamp duties, and it was to stop the tax, basically the estates moving from parent to child. And it's been through various incarnations throughout the years, became estate tax, capital transfer tax, and the current incarnation of it is inheritance tax, and that was introduced in 1986. What I haven't got on the slide, because it's not really a tax, it's national insurance, which is social security charge, and that was brought in 1911, and that basically it was an insurance for illness and unemployment, and now covers pensions and other benefits. So if we move over next, we're looking at sales taxes. So again, we were talking about these this morning. So sales taxes are levied on the sale of goods and services, and they were first introduced in the 1940s and they were called purchase taxes, but now in the current formation is VAT, and that was only introduced in 1973, so that's relatively recent as well. It's charged at standard rate. Standard rate of VAT is 20%. We have reduced rate at 5%, a zero rate, and an exempt rate. And we have exempt goods. Right, property taxes. Now, again, these are a bit old because it's related to stamp duties, and with the inheritance tax, stamp duties, so the act dates back to 1694. Then that's sort of evolved over the years, and we've split out. So the stamp duty originally was a tax on paper transfers, so it then involved land, which was a paper transfer, and the land out of the stamp taxes was split away in December 2014, so relatively recently, and became stamp duty land tax. And we pay, and that's actually, it's actually different for each of the countries within the UK. So England, Wales and Scotland all have land tax, but England has stamp duty land tax, Wales has land transaction tax, and Scotland has land and building transaction tax. All slightly different, but roughly relatively similar. And you pay different rates on commercial property and different rates on residential property being the higher rates. So as a guide, in England, the residential property rates go from 0 to 12% and the commercial rates are 0 to 5%. So it's just been aware that if you buy a property, there is stamp duty land tax. Limited companies. So we won't really cover much on limited companies today, but corporation tax was introduced in 1965, again with the capital gains tax. Currently 19% is our corporation tax rate, up from the 1st of April 2023, that's proposed to go up to 25%. There'll be a small profits ban, but it does go up to 25%. We're then looking at, that probably covers the predominant national taxes, and then we get to local taxes. The country is split into 109 counties, and within each of those counties, that's through Northern Ireland, Scotland, England and Wales, and within those counties a number of boroughs, and we charge council tax, and that's to fund what happens within the boroughs. So it's to fund various services, police, fire, and that's levied by the local council, and it's levied it's levied according to the size of your house and which council you live in. So that covers the bulk of our taxes. So who pays taxes? Well, I'll put this slide is just as a reminder. So businesses pay corporation tax, individuals pay tax, and then we all have the idea of trusts. Now I've put trusts in because we're talking about those later, but they are separately charged to tax. So we then move on to some background information about our income taxes. So the UK tax year runs from the 6th of April to the 5th of April, which is slightly different to the rest of the world, but we're quirky, we like that. A lot of taxes can be collected at source. So if you're employed in the UK, your employment tax is collected at source. So if you're just employed in the UK, it's likely that you won't have to do a tax return. But if you do have to do a tax return, you have to register with the Magistrate in Revenue and Customs, and they issue you with a UTR, a unique tax reference, and you use this to submit your tax return. If you do have to submit a tax return, you pay your tax on the 31st of January following the year of assessment, and then subsequent years you pay on account. So usually you'll pay your tax on the 31st of January in the tax year and the 31st of July following, and then if there's any more tax to pay, you pay that on the 31st of January after the tax year. So your first tax, you get quite a long time to pay your first tax payment, and then it accelerates after you're in the system. Again, we mentioned this in the previous slide of the UK going to the USA. We need to check immigration status to work in the UK. Lawyers, as in America, are separate to accountants, and it is a lawyer that would deal with you making sure you've got the right and correct visas. If you have earnings in the UK, then also you need to check whether you need a national insurance number, and the national insurance number is slightly different, to the unique tax reference. So you will need to get and register for a national insurance number as well. So, excuse me. Right, so individuals pay income tax. Now, when we look at an individual, we have to look at whether you're resident in the UK or not. And if you're UK resident and domiciled, you pay tax on your worldwide income. But if you're UK resident and non-domiciled, so domicile is it's a country where you consider your roots are, where you have a permanent home, you have a domicile of, everyone has a domicile of origin, which is usually the country you're born in, but not necessarily. There are occasions, exceptions to that. And you can have a domicile of choice. So if you're UK resident and non-domiciled, you pay tax on your UK income and worldwide income, but there is an option to elect for the remittent basis. So that would mean that you only pay tax on income you've brought into the UK, but we will talk about that later. And if you're non-UK resident, you only pay tax on UK source income. So then that leads to the question is, well, how do I work out if I'm UK resident? And we have a simple solution to that. We have a statutory residence test. It is it's a number of pages, very procedural. It's a tick box exercise, and you go through and work out whether the tests apply to you. It's so we have a number of tests here, and we have, so there's, looking at this, there's an automatic overseas test, automatic UK test, sufficient ties test. If you happen to die in the UK, just because it's there are special rules. And then also to bear in mind, there is a split year treatment. So you can, that means that if you're deemed resident by the statutory residence test for a whole tax year, but you've only just come to the UK, you can say, I'm going to split that year, and therefore the part up to my arrival, I'll be treated as non-resident. The part after my arrival, I'll be treated as resident. And that applies when you come to work full-time in the UK, or you have your only permanent home in the UK when you arrive. So it's quite useful, because it does mean that you won't be taxed on your overseas earnings the minute that you arrive in the UK for that particular tax year. And the reverse applies when you leave the UK. So so if I move, so how do we do the tests? So the order of tests are that the residence test evolves around counting days in the UK. So a day in the UK is a day that you are in the UK at midnight. So you probably need to keep quite a detailed diary to be able to do the test, so you know where you are each day of the year. And if you're in the UK for 183 days, it's fairly clear cut, according to the test, you're UK resident. If you're here less than 183 days, we then need to check the automatic overseas test. There's 3 of those. And what you just look at, so if you've not been resident before, you get 46 days in the UK before becoming resident. If you've been resident before, you get 16 days. And then there's a working full-time overseas, which would make you automatically overseas resident. So you wouldn't be UK resident. If you then move on, you say, well, actually, I don't meet any of those. You look at see if you automatically UK resident, and again, there's three tests there. So it's the 183 days. Oh, UK resident, working full time in the UK, which comes with some quite complex calculations, but you would be UK resident. And the other one, which is quite interesting, is if your only home is in the UK and you spend 91 consecutive days in that home, but 30 of those days were in the particular tax year, then you'd be UK resident, which that is the one, if any, catches some people out. Other than that, if you don't meet any of those, we're now on to sufficient ties. So we're sort of looking at ties you have with the UK. There's 5 areas we look at here: a family tie, accommodation tie, work tie, 90-day tie, and a country tie. And depending on how many ties you have to the UK, there's a table to say how many days you can spend in the UK before you become UK resident. And of course, in yellow writing at the end, we have a treaty with the US, and there is a treaty tie-break clause in that treaty. So if that's always can be looked at. I'm now, having gone through the background and how when you pay UK income tax and who pays your income tax, I'm going to pass over to Dan, who will tell you a little more about UK income tax.
Yeah, so like Julie's just giving you an overview of the history of income tax, and also who is liable to pay that. And I'm just going to talk you through sort of the different types of income that we have in the UK and how those different types of income are taxed. So broadly, there's 3 types of income in the UK, and they're categorised as non-savings income, savings income, and dividend income. And they're taxed in that sort of order. So your non-savings income is your first slice of income that is subject to tax, followed by savings, and followed by dividends. So this first slide covers the first 2 of those, which is non-savings and savings. And you might sort of wonder, well, what is non-savings income? There is some examples in that first sentence, ignoring the savings, which is obviously the savings income. The rest there sort of fall under the header of non-savings. Equally, pensions would fall into that category of income as well. Yeah, so each individual as UK tax resident will be entitled to a personal allowance. And the personal allowance is, as the slide says, it's up to £12,570 per year. And your income falling within that range of income is taxed at 0%. So it's still taxable income. It's just that the tax rate that's applied to it, no matter which band of income it is 0%. And then for the first class of income, so for non-savings income, it essentially follows the table on this slide. So income above 12,570 up to 52,770 is taxed at 20%. Beyond there, it's 40% up to 150,000, and then further beyond that, it's 45%, and that's just for non-savings income. And it's probably worth mentioning just now that from the 6th of April 2023, that additional rate band is subject to change. It's planned to change to 125,140. It's going to reduce from 150 to that amount. So from that next tax year, the sort of the rate at which the level of income at which you pay 45% is going to reduce. And like I say, that's for non-savings income. For savings income, it's broadly taxed at the same rates, but there are a couple of extra allowances attached to savings income only. And the first of those is called the starter rate for savings income. And what this is for the first £5,000 of income that you have above the personal allowance, so going from 12,570 up to 17,570, if that income is savings income only, so we've only got a salary of £12,000 and then a few £1,000s of savings income, the tax rate is also 0% for that first £5,000. So if you had a salary of £20,000, for example, arising in the UK, this isn't applicable to you because you're already above that 17,570 threshold. So maybe not relevant to many people on this course, but there is another sort of allowance for savings income which may be more applicable, which is known as the personal savings allowance, and that is £1,000 for people that are basic rate taxpayers. So if you're a basic rate taxpayer and your income from savings, essentially, and your bank interest income is less than £1,000, and that will be taxed at 0%. Now, this does reduce the higher your earnings are. So if you're a high rate taxpayer, your level of personal savings allowance is reduced from £1,000 down to £500. And if you're an additional rate taxpayer, it's reduced further to 0. So additional rate taxpayers don't benefit from that allowance. It's for people on lower incomes. Yeah, so as the slide mentions in the second sort of sentence there is a restriction to the personal allowance for people with income in excess of £100,000. And that restriction comes into effect at that level of income, and it essentially reduces your personal allowance for £1 for every £2 that you earn over that level. So for a broad example, if you had £110,000 of income, your personal allowance will be reduced by £5,000, so it would be reduced to 7,570 rather than 12,570. And I mean, for people within this sort of income band between the 100 and 125,000, it is quite a punitive income band, because you're essentially being subject to tax at 60% on your non-savings income and savings income, because you're effectively paying 40% on that income anyway, because you're a high rate taxpayer, plus you're losing your personal allowance and effectively paying 40% tax on that loss of personal allowance. So it's a 40% plus an extra half, 40% on top of that. So it is quite punitive. And there is ways to sort of plan your income, I guess, to keep you underneath that £100,000 threshold that may be worth exploring if your income is in that range. So moving on to the third sentence, all individuals are taxed independently here in the UK. So there is no sort of combined return for spouses and civil partners. Each individual will have to complete their own tax return, and that comes with their own personal allowance and personal savings allowance and so on. There are some minor tax savings for married couples or civil partnerships, but they are very minor and may not apply to most people, as it requires somebody to earn less than £12,000 to earn less than their personal allowance, to be relevant. And then just finally, it's also worth noting that Scotland and Wales have their own, the governments in those countries have their own sort of powers to set the tax rates in those countries. So at the moment, what's on the slide is covering the UK to the extent of England and Northern Ireland and Wales, because they haven't changed their rates at the moment. But Scotland do have different rates. They have quite a few more income bands. There's like a 19% and a 21%. But essentially, if you're going to move to Scotland, again, it'd be worth having a further conversation, just because there are different rates that may apply. And it's slightly higher than the rest of the UK at the moment. So yeah, it's always worth considering that if you were going to move into Scotland. Yeah, and then so that's the first two bands of income that we have. The third band of income is dividends. So, you know, the rates for these are slightly different depending on what level of income you have. It's the same thresholds that were on the previous slide, but it determines whether you're basic, higher or additional rate. But the rates are different, and this covers any sort of dividend income. So, you know, dividends from your personal private limited companies that you own shares in would fall into this category, or if you own shares in companies quoted on the S&P 500 or other stock markets, then, you know, those dividends saw the same sort of type of income in the UK. Similarly with non-savings income, similarly with savings income, there is a allowance for dividends, which is a 0% tax allowance again. At the moment, it's £2,000 for the tax year that we're living in. So up until the 5th of April 23, UK taxpayers get £2,000 of dividends tax-free, essentially, and that's per individual. So for spouses, it can be £4,000, you know, between you. That is, like many things, subject to change on the 6th of April 23. So that's going to reduce, it's proposed to reduce to £1,000 for that tax year. And then further for the following tax year from 6th of April 24, it's reduced to £500. So it's getting less and less beneficial to take dividends, where it used to be quite, you know, the sort of way that you structure your own limited company in the UK is you take a low salary and take a large dividend to supplement your income. But it's HMRC are sort of narrowing the gap on the benefits of that, to be honest. And I think that, so essentially, it follows on from the same threshold bands as the other two rates of income, just slightly different rates of tax. So moving on to the remittance basis. So the remittance basis is something that might be applicable to entrepreneurs in the US thinking of moving to the UK, because this is only applicable to people who are deemed to be UK tax residents. So you've gone through all the tests that Julie described, and okay, you're a tax resident in the UK, but you're not domiciled in the UK, you know, which Julie touched upon as well. So essentially, if you've been born to American parents in America and lived in America all your life and are now deciding to move to the UK, you would most likely be domiciled in the United States. So you're not domiciled in the UK. And if that is your case, you're a tax resident, but you're not UK domiciled, you can claim the remittance basis. And this is something that you do physically have to claim if your income is, your foreign income is over £2,000. So we have to sort of make this claim on a UK tax return. And there's some benefits to this, and there's also some costs to this. So if you do claim the remittance basis, you are essentially only taxed on your UK source income, so employment, pensions, rental income deriving from the UK, and also any income that you earn overseas that is remitted to the UK. And I will come on to what sort of constitutes a remittance on the next slide. So if you have huge gains or employments overseas but are a UK tax resident, it may be beneficial to make this claim because that income, if structured right, will not be subject to UK tax. But one of the downsides of making this claim is that you will lose your entitlements, that personal allowance that we did discuss. So it may be more expensive to make the claim, in which case, you do a comparison one way or the other, and it might be better to actually not make the claim, which is something that we can do on your behalf and make that comparison. But for individuals, like box 1 says, if your income is in excess of £100,000, when you sort of get into the point where your personal allowance is being tapered, or maybe even reduced to zero because you're in excess of £125,000, then this claim could be beneficial because you have no personal allowance anyway. So losing that entitlement may not impact you as much. But there is, as box 2 says, there is a cost. It's the remittance basis charge. So if you are a tax resident in the UK for 7 of the previous 9 tax years, then this charge kicks in, and it's a £30,000 per annum charge. So clearly only beneficial if the tax that you would pay as a result of your foreign income being taxed here is more than that. If it's less than £30,000, then you would not claim this because you're being taxed, or you're paying this charge. That rises to £60,000 if you've been a resident for 12 of the previous 14 tax years. And then finally, if you've been a resident for 15 of the previous 20 tax years, you are now you're now what's called deemed domicile in the UK. So you're no longer able to claim this remittance basis because, it's only available for people who aren't domiciled in the UK. So you might be thinking, well, okay, well, I want to make this claim, and what is a remittance? What is deemed to be remitted income? So remitted income is the strict rules around it, and there's quite complex rules around it as well. But an example may be that you're living in the UK, you've previously been in the US, you come to live in the UK, and you live a lifestyle beyond your means of UK earnings. So you have quite a basic salary or pension in the UK, and that doesn't cover your living expenses. So you use then your US income to supplement that. Well, bringing that income that you've earned since you've been in the UK over here will be deemed a remittance, and that will be added to your UK source income and will be subject to the applicable tax rates, depending on what type of income it is that you have remitted. Similarly, if you sort of say you have an American Express and you're paying for services here in the UK, and then that credit card is paid off, from your US bank accounts, you've bought a service in the UK, and the value of that service then is remitted as well. And I think the final common example for what is remitted income, I'm sorry, question just popped up. So the final example may be that you're in the UK, you've got your property in the UK, and you want to buy some furnishings, or you want to buy some art, for example, but you purchase this with your US income, or you purchase this with your overseas income, and then bring the painting or the furniture to the UK and put it in your home, and you got the benefit of that purchase. The value of that then again is deemed to be remitted. So there's a few sort of basic examples, but there is quite strict rules around this, so it is definitely worth a further conversation if you think this may apply to you. Now, the third point on this slide is quite important. It mentions clean capital, which is a sort of very important planning point for individuals that have been raised in the US, job in the US, and have got quite a lot of income sort of already built up. Whilst you're over there, before you consider moving, you do want to essentially make sure that this concept of clean capital basically means anything that you've earned, gains or income in the US or overseas before you move to the UK, any remittance of that income, so using it to pay for services, assets, etc., isn't remitted to the UK and isn't brought into tax for the remittance basis, or if you don't claim it. For the remittance basis, it isn't considered remitted. It's not earnings. But it's quite important, really, because we aren't able to continue depositing into these accounts that we have. So if you've got a US bank account that's got quite a reasonable sum in there, but it relates to income we've earned before we've become a UK tax resident, we want to sort of keep that ring fenced, and we don't want to then put any further earnings. So we come to the UK, we still have a US employment, we still have US rental income, whatever it may be. We essentially will want a separate bank account to sort of record the earnings that we've earned since being a UK resident, because if that income is deposited into our clean capital account, it creates something called a mixed fund, which is quite complex. But essentially what that makes, but essentially what happens if that does happen, is that account that becomes mixed funds, when the income is remitted to the UK, it's deemed to be remitted from your earnings rather than the clean capital that was there prior. So it's quite important from a planning point of view to make sure you ring fence that clean capital where you come here. If you know you're only going to be in the UK for a few years, you might be able to say, well, actually, I can afford to supplement my income with my clean capital, and I don't need to remit any further income to the UK. So it's quite an important but complex planning point that you should consider before moving. Just moving on from that, I think the last thing I'm going to discuss in detail is capital gains tax, which this is separate. Again, Julie provided a breakdown or sort of a history of this, but it's separate to income tax for UK individuals. So there's slightly different rates, and like Julie says, it sort of relates to the appreciation of our assets. So when we're calculating what capital gain is, we can deduct costs used to acquire assets and also costs in sort of making those sales of the assets as well. And similar to personal income tax, there is an annual exempt amount. So if we have a personal allowance for income tax, capital gains tax is called an annual exempt amount. And at the moment, the current tax year, it's £12,300 per individual. So if you have a property that's owned jointly, husband and wife, you can potentially have £24,600 of a sort of tax-free allowance on a gain of a property or of shares, for example. So it's at the moment quite beneficial, but that again is planned to reduce, similar to the dividend allowances and other things, from the 6th of April 2023. So that at the moment it's planned to reduce from that date to £6,000 per individual, and then further from 6th of April 2024 to £3,000 per individual. So what are the rates for CGT? You know, we know the rates for income tax, what are the rates for CGT, and broadly it's 10 and 20% for most assets like shares and commercial properties and most chargeable assets. And those rates depend on what your band of income is for income tax purposes. So if you're a basic rate taxpayer, you'll begin paying capital gains tax at 10%. If you're already a higher or additional rate taxpayer, it's 20%. And like those boxes at the bottom do show, there is an 8% surcharge for residential properties. So 28% for high rate taxpayers and 18% for basic rate taxpayers. And there is some reporting requirements for capital gains separate to income tax, which I will discuss on this next slide. So this general gains sales of shares in quoted companies or private limited companies, trading companies, would be reported on a UK tax return annually. So it's all sort of part of the same regime, but for residential properties and commercial properties, there is now these new rules which were introduced fairly recently, a few years ago.
It is only a few years ago.
Yeah, so this is a really, really recent change to the UK tax system, but this can affect UK tax residents and non-residents for the sale of properties. And what we have to do is we have to report any gains that are made within 60 days of the completion, and we have to pay any tax within 60 days of completion. So quite clearly a timing issue here, whereas if you're thinking of making a sale or you already have made a sale, there's not much time to get in touch with your accountant in the UK and sort of arrange for this to be done. Because like I say, this does capture non-tax residents as well. So US residents selling UK property or even selling shares in a limited company where the value is derived from UK properties. The second box sort of mentions for some non-residents, there is a rebasing sort of calculation that we can do. So because these changes are quite recent, so originally brought in 2015 for non-residents, now affecting UK tax residents as well. But like I say, for non-residents, this 2015 date is quite important because we can rebase the value of any properties that we owned at that time to the 2015 value. So if you bought property, back in the 90s, it's clearly going to be worth more in 2015 than it was then, just because of general inflation in the property market. So we can treat the cost as being the value at that date if we know what that is, or we can calculate what that was, and we use that as the cost for our capital gain calculation, and you know, the resulting gain will be lower and the resulting tax will be lower, which is good, you know, which is helpful. The previous slide did mention some sort of reliefs that we have for capital gains, and a good one that we do have here in the UK is principal private residence relief. And what this sort of does is, for a period where a property you live in is deemed your principal private residence, that element of the gain is exempt. So if you come to the UK and purchase a property to live in full time, and you own this property, you know, yourself and your wife, just in your own names, sort of for the whole period that you've lived in that property as your principal private residence, then if you sell it, make a gain, that whole gain is exempt. There's no reporting requirements, 60 days of that as well if you're a UK tax resident. And finally, just a slight planning point really, that in the UK, if you're buying a residential property for you to live in, it's tend to be bought in personal names, but they're not really bought in trust or companies. They can be, but it's quite complex and it's not overly beneficial from a tax point of view. So we tend to see them in bought in personal names. Okay.
So introducing Charlotte.
There's just a couple of like tidy up slides. So we've got like this pre-immigration planning sort of just highlights the key areas of what you should think about really before if you're considering moving to the UK. These boxes are what you should consider. And the main point really to take away from this slide is that, you know, being Instructors can help with all of the UK tax implications. And you know, we have connections with UK lawyers to consider the the visa requirements and sort of legal requirements for maybe setting up a company and stuff here. And equally, we can also consider the impact on your US tax returns with the help of Eide Bailey. We can sort of offer a complete package of assistance for people thinking of coming to the UK. Yeah. And then there's just one final slide, which just meant it's just a sort of overview of, you know, if you're going to own a company, if you own a company already in the UK and in the US and you come to the UK, there is some considerations. Yeah, so that you have to consider, you know, it's not really the point of this seminar, but there is things to consider where you may be affecting the permanent establishment of your company. You may be, creating a tax residency in the UK for that company. So there's something to think about. But I will pass you over to Charlotte, and she's going to discuss sort of the trust and inheritance tax that we have in the UK, which is also, you know, quite fun and complex. So yeah, over to you.
Thank you. So yeah, I'm just going to talk a bit about trusts like Dan says. Thank you. So there is two main types of trusts in the UK, the interest in possession trust and a discretionary trust. There's slight differences. An interest in possession trust pays tax on the income that arises in the year at the global rates of 20% for rental income, savings income, 8.75% on dividend income. All of the trust income is passed to the beneficiary in the year that it arises. They include it on their tax return. Now, discretionary trust is the most common trust type of trust used in the UK. They pay tax at higher rates. So any income that arises, say savings rental income is taxed at 45%, dividend income is taxed at 39.35%. The main difference here is that it's up to the trustees whether they pay out the income to the beneficiaries. It's only taxable on the beneficiary when it is paid out. They include it on the tax return in the year with a credit for the tax that's been paid by the trust. So UK resident trusts, they pay tax on worldwide income, whereas non-resident trusts, they only pay tax on UK income. Now, the residence of a trust is determined by the physical residence of its trustees. So a trustee is resident in the UK if all the trustees are resident in the UK, and obviously if the trustees are non-resident, the trustee is non-resident. Where there is a mixture, so for example, at least one trustee is resident and the settlor was resident or domiciled at the time the trust was created, the trust will be UK resident, and obviously vice versa. So inheritance tax is a tax based on domicile rather than residence. Inheritance tax, or IHT, is a tax paid on death, but also on chargeable lifetime transfers. For example, a transfer of assets to a discretionary trust. So the value of a person's estate is calculated on death. If it's less than 325,000, which is the nil rate band, there's no tax to pay. There's also no tax to pay if you leave everything either to your spouse or to charity. It's also worth noting that transfers to spouses are only exempt if your spouse is domiciled in the UK. So anything above 325,000 no rate band is taxed at a flat rate of 40%. You can reduce this rate if you leave more than 10% of your assets to charity. So it will reduce from 40% to 36%. Any unused allowance can be transferred to your surviving partner to use on their death. In addition to the 325,000, there's also a residence nil rate band, which is £175,000. So potentially a married couple could leave £1 million tax-free on death. This property nil rate band will start to reduce if your estate's worth over £2 million. There's taper relief on that, so that's eventually removed. There is other reliefs available for business assets, such as shares of property. So you can get relief at either 100% or 50%, depending on the asset. You may also be able to get relief on some agricultural property. Also, just to mention, non-domiciled individuals will still pay inheritance tax on UK assets. They are entitled to the 325,000 nil rate band. And if the main residence is in the UK, they'll also get the residence nil rate band of £175,000. So inheritance tax and gifts. So there is certain exemptions, allowances that you will get in the UK. So you can make large gifts during your lifetime. These will fall out of your estate if you survive for 7 years after the date that the gift is made. So example, you just gift £500,000 to your daughter, survive for 7 years, your estate reduces by the £500,000. If you die within 2 years, the gift will become taxable at the full 40% rate. But gifts given between 3 and 7 years before death are taxed on a sliding scale known as taper relief. So an individual can also make small gifts without any inheritance tax implications. So you've got £250 you can give to any individual, they're exempt. £3,000 per annum per individual donor. You can, if you don't use this one, you can carry it forward, give £6,000 in 1 year, and that's totally exempt. One of the most valuable exemptions, I would say, is a regular gift out of income. So, for example, an individual who has £100,000 worth of income in the year, but doesn't have many expenses, can live comfortably off £20,000, £30,000, can give the rest away without any implications. So potentially £70,000, £80,000 per year, tax-free. As I mentioned previously, a gift to a trust is called a chargeable lifetime transfer. So if you make a gift to a trust which is less than the nil rate band, there is no tax charge. If it's above the £325,000, there's a charge of 20% on the excess. So both Dan and Julie talked about domicile. It is usually decided at birth, but for tax purposes, it is determined by where you live or have your permanent home. So if either condition A or B is met, which is shown on the slides, you are treated as domiciled. Now, like anything to do with tax, domicile is not straightforward, can be quite complex. So any questions regarding this or anything else that we've mentioned earlier in the slides, just please get in touch.
Alice, thank you very much, isn't it? Are we over to Jared now to tidy up?
Well, was there any questions that came through, Mai?
Thank you.
There is that one question that's in there.
Yeah, thank you everybody for your participation. I'll get to that. So appreciate Caroline and Julie and Charlotte and Daniel for their expertise and sharing with us today.